The latest Core PCE price index release on Wednesday provides one of many highlights over the course of a week that also sees 4 of the Mag 7 names report their latest earnings alongside a raft of economic data that really ramps up towards Friday's jobs report. But this inflation report will be important as we try to gauge the direction of travel for the interest rates under the Federal Reserve. And of course, with the decline of the US dollar, will this release provide yet another reason to sell the greenback? So let's go through the data as we always do. This is the outlook for the release on Wednesday. You can see in terms of the core PCE price index, we're expecting to see a deterioration in both the monthly and the year-on-year figures. 2.5 expected from 2.8 on the year-on-year. The monthly figure down to 0.1. That would really be encouraging and pointing towards the possibility of the Federal Reserve being allowed to act. Ultimately, they're having their hands tied by what's happening under Donald Trump and with these tariffs uncertainty. And that's going to continue apace, quite frankly. There's an element of this is going to be essentially overlooked by many within the markets because of the fact, as you see here, that this is March data, right? So what happens once we see the enactment of these tariffs? And so certainly there's going to be a greater importance attached to those releases that are for April, and that notably is going to be the likes of the ADP payrolls and the jobs report on Friday. But this will also be important because it does provide the basis for expectations in terms of inflation right now and the view of the Federal Reserve. So an expectation down to 0.1 on monthly and 2.5 on the year-on-year metric. Now, this comes against a backdrop of sharp upside in terms of expectations across the board. You know, we've seen it across a number of different metrics. The 5-year is one area which doesn't show it, quite frankly, but many of these other so-called soft data points provide exactly that same view. Now, this is the University of Michigan Consumer Sentiment Survey, and you can see both the 1-year and the 5-year inflation expectation metrics have absolutely soared of late. So there is a perception that we will see a sharp rise in terms of inflation. Now, does that mean they will happen? Not necessarily. What people are expecting to happen versus the reality of it can often vary quite wildly. But this is certainly important because it does provide the basis for people to front load their purchases, which is something we saw prior to the tariffs. And people thinking, if prices are going to go up for my iPhone, why don't I buy it now? So certainly that does provide the basis for potential inflationary pressure over the near term. But we don't necessarily know that that is exactly how it's playing out. Now, this is 6-month annualized inflation. It's a way of looking at different metrics of inflation and seeing exactly how they're reacting over the last 6 months rather than 12 months. It gives you a little bit more of a, not necessarily granular view, but it's a bit more of a recent view because sometimes those year-on-year metrics can be skewed by something that's happened, say, 11 months ago. And what's notable here is that we've seen, bar the shelter figure, all of these figures start to turn lower after a recent rise. So we have seen a resurgence of inflation pressures of late, but that's actually turned lower over the last monthly figure. You might notice here the core PCE figure is the one that's not been updated for the month of March. So we're waiting for that. These figures are all derived from different metrics within the CPI figures. But we can see here there's a good chance that that move down to 2.5%, which is what markets are expecting, points towards a continuation of that same trend that we're seeing from the CPI figures. And that's highlighted here, right? So these are the month-on-month figures. Sorry, should have changed the title for this. This is month-on-month inflation across CPI, headline CPI, core CPI, and core PCE. And you can see by and large the three of them do move to some extent in lockstep. What we saw was February, we saw a bit of a pullback, but a continuation of the upside move for core PCE. But then in March, we've seen a sharp drop-off in terms of inflation pressures for both headline and core CPI. And so the question mark is, do we see the same kind of thing for the PCE figure? And we can see in terms of market expectations exactly what is expected, because markets expect a 0.1 figure on the monthly core CPI, core PCE metric this time around. So all of a sudden, inflation just disappears. And much of that is going to be around fears that we have around the direction of travel for the economy under Donald Trump, with tariffs breaking essentially trade relationships around the world. Here's a different way of looking at inflation metrics. So I'm just comparing the headline CPI, which is what I believe the Federal Reserve are likely to follow if they're looking at headline numbers, alongside the core PCE, which we already know the Federal Reserve follow in terms of their core figures. So we've seen that decline down to 2.4% on the headline CPI figure. The core PCE measure is at 2.8, but like we said, markets are expecting to drop down to 2.5, significant decline. So where do we stand in terms of base effects? Well, this time around it's March. So if we look at March last year, it was a fairly chunky reading, well above that dotted line, which is where we need to be on track for a move down to 2%, which is essentially 0.16 recurring. And so that provides the basis for disinflation this time around, which is why we're expecting to see that move down from 2.8 to 2.5. So you can see here in terms of the March CPI figure, essentially non-existent inflation. If we see a similar kind of thing, we'll see essentially near enough no inflation, replacing a figure from last March, which was, excuse me, which was relatively elevated. Then April, we might see further disinflation because you can see the same kind of thing. Then May, possibly, we see an end of that. And in actual fact, we could see inflation rear its head once again in May. But we're not there right now. And so disinflation is the theme this time around. Excuse me. But so there's just question marks as to whether we're actually going to get down to 2% ultimately. But for the near term, it seems like the theme is really around disinflation. And so it's important to understand exactly how this can impact market expectations. Now, like I said previously, you do have the case that people are saying, well, I'm just going to disregard it. It's a March figure. And what's going to happen once April comes around, May comes around, and we see these tariff pressures start to kick in? Well, as things stand, you can see market expectations for interest rate cuts from the Federal Reserve this year point towards a 1, 2, 3, 4 rate cut move over the course of this year. So 3 or 4 rate cuts left. Excuse me, a bit of a tickly cough. 3 or 4 rate cuts, that's a fair amount, right? I think it's something like 6 meetings left this year. So a rate cut every 1.5 meetings. And so how are we looking to see shifting market expectations around this? Do we see weak inflation coming out this core PCE figure that drives greater expectations for easing? Possibly. Ultimately, these tariffs are expected to weaken the economy, but also strengthen inflation. So that's where we have the question marks coming into play, because if we see a stronger than expected inflation metric, then people might say, look, inflation is coming in high already, and this doesn't even factor in the tariffs. If we see the weak inflation metrics coming in, then people could still say, well, maybe next time around it's not going to look like this. This might be just the calm before the storm. We see a reflation coming into play. So there is that caveat. But if we just take it on face value, ultimately a sharp decline in terms of headline inflation does point towards the possibility that the Federal Reserve essentially start to look in the position that they could cut rates in a more meaningful manner. They need to know that inflation is tamed. But like we said, this doesn't necessarily mean that it is tamed, because we're still yet to see the impact of the tariffs, certainly. But nonetheless, expectations of where interest rates are in the future will inform price action for the likes of the US dollar, amongst others. So we can see that here. This is the expectation of where rates will be for that December meeting, which is the blue line. Then we have the green line, which is the dollar index. So how does the dollar index shape up? It's notable that what we have been seeing for the dollar index is a very sharp decline of late. We can see exactly that here. This is the monthly time frame. So we've seen this collapse down through support, now trading into levels not seen since April 2022. From a wider perspective, we can see here that this is part of a potential uptrend. And so we could say, well, is this another retracement? Let's try and grab that. There we go. Is this another retracement before the bulls come back into play? Well, one port of call for us to try and answer that question would be to look for trendline support. Another one would be looking for Fibonacci support. So let's get that fib drawn on there. So trendline support below where we are at the moment, it points towards a possibility of further downside to come, even if we remain within this trend. Fibonacci support, you can see we've moved through the 61.8 fib. We've now started to move towards the upside. The fact that we've moved through that level does point towards a higher possibility that we then continue to move towards the downside from here. The weekly time frame shows you that we did post a somewhat bullish candle last week. You can see that long lower shadow. We recovered all of that sell-off and some ended in the green for the week. But the daily time frame does highlight the possibility that we see something akin to this, right? I mean, you can see short-term ends of that sort of intraday trend, but ultimately then that wider bearish sentiment starts to kick in once again. The 4-hour chart highlights exactly that, right? We didn't take out that initial swing high, which is here at 100, essentially 100.276. Instead, we've sort of teetered around this area and now starting to sell off. From a fib perspective, let's just see where the 76.4 is here. So we've gone through the 76.4. We're around that area though, really. Let's just, for some reason, that's not allowing me to edit. It's strange. Anyway, what we're seeing here essentially is the sort of rebounding around that 76.4 fib level and now starting to roll over. On the hourly time frame, that rolling over is a lot more evident. Let's get rid of that fib. And we can see here it's sort of a double top formation with the neckline taking place at this level here, which is 99223. Let's follow this over the intraday sort of charts. So we've got this hourly time frame. It shows you the very clear bearish trend. We see the sell-off. That sell-off then ends up creating a higher low and a breakthrough resistance. Double bottom formation completed, points towards retracement phase starting. Retracement phase starts, we see the creation of higher highs, higher lows. Then suddenly we falter at the creation of a new higher high, instead creating a lower high. But do we confirm the potential reversal yet? No, not yet. But then we break through this low. So the breakthrough, your 99223, to me points towards the beginning of a next bearish phase for the US dollar index. Now, of course, we're coming into this period where we could potentially see weak inflation data, and that could inform us about the possibility of further downside in terms of interest rates under the Federal Reserve. We don't necessarily know that that's how it's going to play out. We don't also know whether inflation is going to drop to the same degree. We don't know if markets are actually going to look at it and say, well, we don't care about this because ultimately it doesn't factor in tariffs. So there's a lot of uncertainty around this. But from a purely trend following perspective, we've got a potential for further downside coming into play once again here. Remember, the long-term trend is bullish, right? So you do have the possibility that the bulls come back into play at some point around this area. But we've come through to 61.8. We've got that trend line and 76.4 fib down below. I think there's a good chance that the bears come back into play, in particular if we see a particularly weak inflation report coming out on Wednesday. Of course, we've got a lot of other things going on at the moment, but certainly as things are playing out at the moment, it seems like that dollar decline, that dollar weakness story, the dollar sell-off could be coming back into play with this latest retracement, break of structure in terms of the creation of higher highs, higher lows, turning into now lower highs and lower lows. And so for me, the dollar index and the US dollar looks like it's at risk of rolling over once again as we head towards Wednesday's crucial Core PCE Price Index inflation report. I hope that's been useful. I am Joshua Mahony, Chief Market Analyst at Scope Markets. I've been away for the last week and a bit, so that's why you probably haven't been seeing that much content from me, but I'm back now. So looking forward to covering all the madness that's going on within markets at the moment. I'll make sure to provide a video for the jobs report on Friday as well, because that's going to be an absolutely crucial one. It's an April report, so it should tell us whether we start to finally see the US economy break after a series of surveys that point towards weakening. But we haven't necessarily seen that in the hard data quite yet. So do we see it this week? Time will tell. Thanks a lot for watching. Make sure to like, subscribe, and follow us for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day. See you later, guys.